Good morning, everybody. Good morning. Welcome to today's Morning Coffee with Mike. We are doing a follow up to yesterday's call where we started to talk about how to position size differently and how we can take on less risk and really adjust how we're going to manage risk in different market environments. I spoke to Mark offline. Now, this question came in from one of our viewers about managing risk. I spoke to him offline and found out a little bit more about what even brought up the question. What brought up the question was a particularly bad loss. The trade was in CPRX. I'll share the trade with you guys in just a moment. This was a trade that many of us were in. I was in it too, and I want to share with you what happened in this trade. So let's bring the camera over here for Instagram, and I'll share the screen over here on YouTube and everywhere else. Uh, as you guys are watching, if you have questions, please type them into the chat, and we'll get to all the questions in a moment. But here is the trade. Just switch the screen over on Instagram, and I will switch it over here on all the other platforms. Oh, Mark, you're with us. All right. So going a little bit deeper based on the conversation that we had offline, Mark, or that great DM that you had sent me. Very, very detailed. So I was in this trade as well in CPRX. A lot of us were. As you guys could see on this trade, I'll share with you exactly how I traded it and why I think that this is actually a great trade management question. So I'll share with you what I did and how some of our members traded it too, and what the end result of it was. So, like many people, I was in CPRX back in January. In fact, I had entered on January 6th when it broke out of this pattern. If we scroll out a little bit more, the way that I saw this pattern was that it was forming an ascending base. An ascending base generally means that you have one tightening area followed by another tightening area and another tightening area, kind of like a VCP, volatility contraction pattern, for those of you that follow Mark Minervini. But the difference here is that it's moving progressively higher. So this area here, this area is slightly higher than that area. This area here is slightly higher than that area. And you can see too that the price action is getting shorter and tighter along the way. So when I bought this, I bought it right here on this day. I'll zoom in again. Right here on this day. Hopefully you guys could see this well. And I got in at roughly $18.90. Maybe let me see what was my exact buy point. And so this is another great thing that I would recommend that you do too if you're not already doing it. And that is to have a trading journal where you're going to log your trades, your thoughts on the trades, entry notes, annotate the chart, and also the individual entry and stops, targets, your average closing price, all these things, and then keep notes on the trade as the trade progresses. Because if you're keeping notes as the trade progresses, then you're able to go back and see what you were thinking on a particular day. So back to the chart. So looking at this, I was in this trade, broke out on this day here, and on day one, it hit my first scale out. So here's something else. I like to scale out of trades into strength on the way up. Uh, there's a variety of reasons and a variety of benefits to scaling out of trades on the way up. The first is that it helps you lock in profits. The more profits that we're able to lock in, the more money we have in our pocket. The way that I look at trades is I want to look at trades in 3 stages. 3 stages, arguably 4 stages. The first stage is going to be the open. During the open, what I like to do is, and let's take a look at the chart. I want to get my stop to break even as soon as possible. I By getting our stop to break even as soon as possible, what we're doing is taking risk off the table. So getting that initial risk. When we put a trade on, the initial risk is the difference between our entry price and our stop loss. So I want to get that initial risk off the table as soon as possible, and I have rules to do that. So once the initial risk is off the table and I start to scale out of the trade, then that's putting money in my pocket and the initial risk is off the table. Great. So price continues to move up and then it hits my second scale out over here. Now, what's the point of these different scale outs, right? Well, why continuously sell into strength? There's different reasons. My first reason is to lock in a token amount right here and try to get my stop to break even so my initial risk is off the table. Then this scale out, where not sure if you could see it well on the screen, but this is 10%. My average gain is roughly 10%. So when price gets to 10%, I like to take off half the trade or make sure that I'm out of half the trade. So that way I'm locking in my average gain. That way, if the trade falls, then, well, at least I locked in half of my average gain. If the trade continues to run, then, well, thank God I held on to half of it to allow it to keep on pushing higher. That's the mindset. So then it keeps on running for the next day over here, and it gets to 15%. At 15%, I'm taking off some more of the trade. Now, why do I keep on selling off in these seemingly 5% increments? Well, in this case, it so happened to be that my average high watermark was 15%. Now, what's a high watermark? A high watermark is the highest point that price gets while you're actually in a trade. And I'll go back and I'll look at, well, what's my average high watermark? And I track that in the spreadsheet too. So if we're looking at this spreadsheet, we come over to, yeah, right here. I'm tracking my average high watermarks on my past trades. And so over the recent past trades, I saw that my average high watermark was roughly 15%. So great. I'm taking off another percentage up here. So at this point, I like to sell 10% at the first scale out, 40% at the second scale out. So now I'm out of half the position. Then I'll sell 25% at that third scale out, the high watermark scale out. So I'm out of 75% of the trade at this point here. That last quarter of the position, what I'll do is I'll let that run until there's some kind of a major sell rule that triggers. A major sell rule would be something that tells me the move is almost done. And that can be either into strength or it could be into weakness. But the idea is that I want to allow the high watermark level to go as long as it possibly can. So I'm out of 75% of the position. And then my stop at the time, I believe, was, well, let's see. Well, where was my stop on this? Let's see if we come over here to my notes. Go through some of the notes over here. Yeah, there were all those danger signals. Oh, so my backstop was at 1890. 1890 was right by break even, right around there. So on this day, I got caught in this move too. And this is where Mark got caught, and this is where a lot of people got caught in this move. Uh, it blew past my stop loss, which was at 1890. I got filled close to the open. The price opened at 1832 on that day, and I sold roughly at around that level. Because I had scaled out into strength, I was still able to lock in gains. And my Gain on the trade was 6.82%. Though when you're up on the trade 15%, that might sound like, God, geez, that really sucks. But when you come back and you look at the management of the trade, and if a trade gaps down on you 11% at the open, right? So from here to there, that's about 11.5%. That's still great to be able to walk away with gains. At one point, this trade was down 35, 36% on the day. Having stop losses can really, really help you. Having stop losses is what prevents you from, if you're thinking of a stop loss like a seatbelt, you would wear a seatbelt if you're driving in a car. And if you get into an accident, the seatbelt is going to save your life or help to save your life. That's what it did for me on this trade. Yeah, getting out here sucks, but it would be far worse to get out down here. Selling into strength along the way helped to make sure that, yeah, that's a terrible gap down, but most of the trade was sold into strength up here. So even with a gap down, I'm still walking away profitable. We did another exercise on that trade with our group that said, well, what would have happened if you just kept on holding? Like, let's say that you sold differently into strength. What would have happened if you held for the worst part of the gap down? What would have happened if you held for the worst part of the gap down? You still would have walked away close to break even, right? So if you had sold into strength, and let's say that you weren't fortunate enough to get out over here, but let's say that you sold at the bottom, what would have happened was you still would have walked away close to break even. And the reason why is because by taking off bits and pieces up here, up here, up here, and selling into strength, that's something else that helps to cushion the fall for this. There are there's a lot of ways to trade. There's a lot of ways to trade. My preference for scaling out into strength is because I don't like being caught in moves like what CPRX did. And when I started out trading CanSlim, for those of you that are familiar with CanSlim and for those of you that are familiar with William O'Neill's work, he was trading on the intermediate to longer term timeframes where he would be holding trades for months and holding for the much bigger move of several hundred, several thousand%. Much of his work resonated with me, but not that part. I wasn't able to hold through those big moves because if you're going to hold for a big move, you have to be willing to accept hits like this on CPRX. And you could be in a trade for several weeks, several months, and then all of a sudden those gains are poof, gone. I didn't like that very much. So when I eventually found Mark Minervini's work, I found out different ways to manage trades. And I went deeper into some of the IBD master level workshops and saw that there were other ways to manage trades rather than holding for the big move. That resonated with me more. And so because it resonated more and matched more with what my goals, objectives, what my beliefs were, what I'm able to execute, I was able to go off and manage trades in the way that I just outlined a lot easier. For some people, let's say Jim Ropel. Jim Ropel was on the uh, Trading Mind Wheel virtual conference. Well, one of the speakers did a fantastic job. He holds for the big moves. He is comfortable with trades coming in, holding through those big consolidations and riding them up again later on. That works for him, doesn't work for me. What's going to work for you is what aligns with your beliefs, your goals, and your ability to execute. The clearer you're able to get on those things, the better time you're going to have trading. Everything that we just spoke about is all covered in the Trading Mind Wheel book, which is available now on Amazon, Barnes& and Noble, Target, Walmart, basically everywhere books are sold. And if you happen to live in the New York area, I'll be signing copies of this book tomorrow, Saturday at 3 p.m. Uh, at the Barnes& and Noble in Massapequa on Sunrise Highway. So looking forward to seeing you guys there if you're in the area. Other than that, let's take some questions. You guys over here on Facebook, LinkedIn, YouTube, Twitter, get your questions in. I will scroll through Instagram. Now let's see here. What questions are coming in on Instagram? We got a question from Mark over here on YouTube. Great points, Michael. I tried to sell, very similar as you. I did just check, and I was mistaken. The trade that went south on me was actually CRDO, not CPRX. Same principles, though, were followed. All right, let's take a look at CRDO. Yeah, that was another one. That might have been the one that came up in. Oh, yes, it was that one. Now I remember too. Thank you for bringing this up, Mark, because this was one that I actually was not in, and we spoke about it in the group. So let's take a look at this one real quick. You can see that my annotations were still on this one. This was where it dropped 45% on the day. And following those same principles with CPRX, right? Like, so this is one where price ran 27%. You could have bought in over here. I was not in this trade, but if I was, I'd be a pretty happy camper. Right? So if you would scale that up 5%, 10%, 15%, you're out of 75% of the trade at this point. And then you're caught in this move just for the last quarter of the trade, you still would have walked away break even. And that is why I like to sell in the way that I sell, because it helps to avoid the pain of this. It helps to avoid those big drawdowns. On the flip side, you are turning your edge over a bit quicker, right? So if you're trading the way that I do, and the way that many swing traders do, the flip side is that you're going to be more active. You're going to be turning your account over faster. There might be periods where there are no trades to take. That was one of the other points that Mark made too, that sitting on your hands for a while, there might be no trades to take for a very long period of time. I experienced that myself. Same thing this year. There haven't been very many trades that I've been in. I think that I've been in grand total. Let me check my my list over here. Yeah, I have been in 19, 20, 23 trades so far on the year. Pretty close to break even on the year. Some periods are more challenging than others. And a lot of people take that personally. A lot of people take quote unquote challenging periods as personal, that they need to get better at. And in some cases that's absolutely true. Every system, however, will go through periods where it kicks ass and where it's not a great time for that particular system. The answer is not to toss the system or to not trade it at all. The answer is to understand when the periods for that system are great and when they're not. One of the ways that I'm able to tell when it's a good time for my system is by following the stocks. And by following the stocks, that means that I'm only going to place what I view as high quality A level or B level trades and see how they do. One of the ways that I help to manage that, and something else that I talk about in the book too, I came up with this tool called the Trade Gauntlet. Now, what's the Trade Gauntlet? The Trade Gauntlet is, well, why tell you when I can show you? So let me come over to uh, my other website, marilwolf.com. Now I've got two websites. I've got the book website and I've got this one here. So let's switch this around again. So this is marilwealth.com. And up at the top over here, there's a little thing that says links. And if you go over to links and you click on Trade Gauntlet Calculator, that's going to bring up this thing. And what this is it's basically a weighted average checklist of all the things that I look for in a trade. Yes, you can put in the ticker and the entry, exit, target, all that good stuff, and it'll calculate that. But there's all these other categories that I'm looking at to see if the trade fits my criteria. I want to make sure that every trade that I take meets the things that I'm interested in. No trade is going to meet 100% of this stuff. There's 97 different things that I'm interested in. And I'm only going to put trades that I view as ultra high quality through this because it does take a couple of minutes to do. It takes me maybe about 5 minutes to run a trade through this. But if I'm running 20 trades through this, that's taking me over an hour, right? So I don't want to do that. So just the best of the best. And then this will generate a score. I'm only going to take trades that score 7 or higher. The reason why I'm only going to take trades that score 7 or higher on this thing is because I went and I reviewed all the past trades, right? So I've got my playbook and I track all of the trades that I take. And the best trades have all gotten 7 or higher. Every single one of them. So great. Now I know that I don't need to take trades that score less than a 7. Yes, some of the ones that do score less than a 7 will continue to run higher. But the best trades, all of them scored 7 or higher. So that's why I use that tool to help verify. So we only want to be in the best of the best trades. Back to CRDO, just for a quick second to wrap that part up. Bring this back over here. So with CRDO, scaling out using the trade management technique that I mentioned earlier would have netted break even on this trade here, even with waking up to a gap down of 45%. Right? Because price actually opened down here. So, bit of insight into how I personally trade, why I do what I do, a few different ideas that you could pick apart and take what works for you, leave the rest behind. That's a big part of my philosophy, and a lot of what I talk about in the book as well. And it's not just giving techniques, it's giving the why behind it and the different mindsets that led to it, a lot of different questions too. And that's a big power of the book. So if you haven't gotten it yet, I highly recommend that you pick up a copy. All right, let's see what other questions have come in. Let's see what other questions have come in. And by the way, Mark, thanks so much for your questions and for the DM conversation. I think that this led to a really, really great episode that hopefully has helped a lot of people here. Just scrolling through Instagram. You guys over on Twitter and YouTube and everywhere else, type into the chat. Let me know what questions you guys have. Somebody was saying so many indicators. It's it's actually not a lot of indicators. I just like to draw all over my charts. The most important thing is that your charts make sense to you. And if somebody tells you that there's too much of something or too little of something, unless if that person is your mentor or your coach and has an intimate view of how you operate, then don't worry about what the person's opinion is. Right? Does what you're doing work for you? Is it getting you towards a certain result? If it is, great. If it's not, then you need to question, what do you need? Everything on my charts are all things that I use and that I have a great knowledge of. It looks like there's a lot, like, yeah, I'm looking at one of my charts right now just to bring it back up over here onto YouTube and bring it up over here on Instagram again. Yeah, this looks like a lot of different indicators, right? Like, oh, now there's candles. I actually like looking at bar charts better, but it looks like there's a lot of things. There's these colors over here. There's these colors over here. Well, what in the heck are all these different lines and all that stuff? If we take the annotations off, there's a little bit less, but I'm just looking at the price action. I'm looking at the volume down here. This bar down here is telling me the percent daily range. So the average percent daily range. I like to see that at a glance because it's telling me if a trade moves, uh, how a trade moves, and if a trade is likely to really likely to hit my first scale outs quickly, or if it's a more of a slower mover. I tend to avoid stocks that are slower movers. This line over here is the relative strength line, relative strength versus the S&P. That's something that's critical for how I trade. All these lines up here, those are just moving averages. And this up here is the stochastics. That's basically what I look at. And then everything else are the annotations, just how I am seeing things develop, Fibonacci's, where I'm entering, target, stops, those kind of things. That's it. Most important thing is that it makes sense to you guys, or that it makes sense to you, right? Like, hopefully, if you're working directly with me, then my charts would make sense to you, and I go through things and I explain them. But the most important thing about your charts is that your charts make sense to you. See what other questions have come in here. How to believe in your setup. The way to build belief, whether it's belief in a setup or really belief in anything related to trading, is going to be through your testing. So how do you do testing? Well, what does testing even mean? There's three categories of testing. I talk about each of them in the Trading Mind Wheel book. The three types of testing are, first there's factor modeling, then there's back testing, then there's forward testing. Talk a little bit about each three, and then we're almost out of time here, so that'll be it for today, and then we'll do some more next week. Wrap up with testing. So testing, what's factor modeling? Factor modeling is taking a look at what works and dissecting why this thing works. there's a few different ways that you could go about doing that. You could first go and read other people's work that have actually gone back and have done those types of studies. There's loads of them. You don't need to start from scratch. O'Neill did work that went back to, I believe it was 1880 or 1890, and he outlines all of it in How to Make Money in Stocks. The book is on the bookshelf back there. It's the green one. Not sure if you guys could see it. Fabulous work. Highly recommend looking at O'Neill's work if you are interested in growth and leading stocks. Fantastic work. So he went back and he looked at, well, what were the common things about the stocks that ran 500 or 1,000%, and he picked it apart and he found certain fundamental characteristics. He found certain things in the chart and certain times when stocks would be most likely to do that. Great. So we got all those different factors. And just because the factors are present doesn't mean that it's actually going to work all the time. But you don't need it to work all the time. You just need it to work enough to where there's more money in your pocket after you do this trade many, many, many times. I believe his average win rate was somewhere in the neighborhood of 60%. You could be successful with less than 60%. My win rate is about 45%, but I also make about 2 to 3 times what I risk. So if you're thinking about a coin flip, if you get paid $2 to $3 when you land on heads, but you only lose $1 when it lands on tails, that math works out very well. So first, anyway, back to the subject. First method of testing is factor modeling. So when you start to see how something works, then that's what's going to implant the belief. Now, reading books or watching videos or listening to me rant for half an hour is just one part of getting a belief. You also need to go in and get your hands dirty. That's where back testing and forward testing comes into play. You get to go in and you get to see how this setup actually works. I recommend doing back testing first, a manual back test, not going and putting it into software, but manual back testing. So that way you could actually go back in time and live how these trades moved and how they developed. So that way you could see with your own eyes what it would be like to trade these things. Then you could see, well, this is how it worked out well. This is how it can sometimes fall apart. And that's going to help to build the belief. That's how you're going to start building reps. You do that part in the back testing environment. I would say back test at least 100 trades that you've already factor modeled. Then after that, you do the forward testing. And in the forward testing, that's when you're trading in real time. You could start with paper money if you want, but you could also start with just a little bit of capital. If you are going to put up your money, I would recommend using a small amount, not your full account, just an amount that if you were to lose it all, wouldn't hurt you if you lost it all. Typically, if I had to throw a number out there, percentage amount, start with 10%, 10% to 20% of whatever your full amount was. So let's say if you were starting out with 10 grand, start trading with a grand, or start trading with two, and see how that goes, and have the expectation that I might lose all this, right? So use an amount where it won't hurt you if you do lose it all, but if you did, well, you should also care about it, right? Because if you're trading with an amount that's so small that you don't care about it at all, then your other emotions and beliefs aren't tied into it, and you don't get that part of the training. And that's what this is. Anyhow, we are out of time. I want to thank you guys for joining me today. It's been really, really great. Mark, thanks again for the fantastic questions. Please hit me up with additional questions. I think that is how these sessions go extremely well. And if you're sending in questions ahead of time, it gives me the opportunity to think deeply about it and give you guys great answers like what we got here today in a great conversation. So send your questions in. You could message me wherever you happen to be watching this, or go over to marrowwealth.com. There is a contact section over there. I'll put it over here onto the screen. Bring this back over here for you guys on Instagram. So come back over here. If you scroll down to the bottom of marrowwealth.com, there is a little contact button. Where's my mouse? Little contact button right down there. Contact us. You click on that, and then maybe it opens up another page. Oh, there we go. Yeah, and then you just fill this out, and you'll be able to get in touch with me. You could submit questions that way. Anyway, one last time, if you're in the New York area, I'd love to see you tomorrow. I'll be signing copies of the Trading Mind Wheel at Barnes & Noble on Sunrise Highway in Massapequa. I'll be tweeting about it and posting it on social, all the details later on. But I hope to see you there. That's it for today, everybody. Have a great rest of your weekend, and I will talk to you next week. Take care. Much love. Peace out, everybody.